G'day there, Wealth Press traders, subscribers, viewers, and investors. Welcome to another Monday morning roundtable. And this week I'm joined by Adam Sarhan, Jeff Zananiri, Jeff Yasteen, and of course, Roger Scott. Gentlemen, welcome.
Hey.
Thanks for having us, James.
You bet. Gentlemen, the topic of the day is clearly COVID-19 and it's spiraling out of control. Hospitals are overwhelmed. What is the effect going to be on our markets? Roger, let's start with you.
As of Thursday last week, I was fairly convinced, and I'm fairly convinced that we are going to see a lot of what we saw last February, March, and April, that we're not going to get out of this unscathed. I'm seeing a lot of tension in the NASDAQ. I'm seeing put to call ratio. I'm seeing momentum levels, and I'm seeing how the NASDAQ is reacting. And if I was a betting man, I would bet a lot more than we're going to see some down, sort of a repeat of what we saw last March. If I think we're going to see that again.
Sure. Jeff Yasteen, how do we prepare for that?
Well, if you're doing new positions, and you feel like you have to buy, buy small, which is something, all of us have spoken about and in recent months at different intervals like this. My overall sense of the market, given this, the terrible, increasingly terrible news on all this, is I guess I have a split opinion on it. I feel like you have to be very, very careful. On the other hand, probably any other time of the year except December, I'd say, it's a goner. We're due for a 5%, 10% pullback. But being here in December and considering the other sort of COVID vaccine developments going on out there, I'm not sure. I feel like since it's coming up on the end of the year, it may just be one of those things where we just continue to melt higher. That's the direction I lean. Only as dangerous as that is, that's the direction I lean, mainly because I feel like you've got the COVID hospitalization, and death rates and all that on one side. On the other side, like later this week, you're going to be seeing the stuff about, the vaccines, maybe on Friday landing at, different airports around the country, and, the vaccinations for nursing homes and that sort of thing. So it's sort of like you got really bad stuff on one side, but, visually you've got this other, light in the cloud sort of thing. And I'm not sure if we're going to get like a big sell-off. I think we could just move sideways and then continue to move higher into the end of the year. But again, given all that, I would be very, very careful with any new positions.
Sure. Adam Sarhan, are you deploying capital? If so, where?
Sure. I think I echo what Roger and Jeff Y just said. And to an additional point to Jeff Y's other side of it, we also have a massive stimulus plan that may be passed sometime in the foreseeable future. So not only do we have vaccines, which is the Main Street side of it, but Wall Street will benefit from a potential stimulus, another round of stimulus, and same with Main Street. So that's one side of it. But to Roger's point, there is a big question mark. If we get a situation where this does spiral out of control, and I look at history for some kind of precedent, back 100 years ago with the Spanish flu pandemic we had back then, there was 3 big waves. The second wave was the biggest. Now, this time around, you could say that the second wave already happened in the US. This could be still part of the second wave because it never really went away. But I'm of the mindset that this is now the crux of it, the worst of the situation. Hopefully, we will get through this. And then hopefully this will all be behind us in the rearview mirror. With respect to deploying capital, I'm of the mindset we are at all-time highs. We do have sentiment gauges extremely bullish, like Roger mentioned with the put call ratio, and almost every other technical indicator is extremely bullish. And that's okay from every once in a while. But when it stays at those elevated levels for a prolonged period of time, like what's happening now, you want to err on the side of caution. So how do investors take some caution? You could buy a good hedge ETF is what I like, which is ticker HDGE, and that's to hedge your portfolio. It's a short ETF that basically short stocks, and it's designed to hedge the long side of your portfolio. Lots of other ways you could do it. Also, you could lock in some profits, which happens from time to time, which profit taking, and then you can also just reduce your exposure and then look to buy after the next dip. So my investment strategy in general is I like to buy the bounces after the dips. So I don't just buy dips blindly because you never know how far the dip will be or how long the dip will be. But I like to wait for that dip to come and then buy the bounce after the dip. So from now, from a risk reward standpoint, patience is warranted in my humble opinion.
Okay. Jeff Z, what are you trading?
I put on a gold miner position last week in Newmont. Roger was talking about it earlier, and I put on pairs, and gold has been unloved. And I just think we're in this dollar debasement environment. We're in a greedy situation. People want returns. They get out of stocks. They get back into stocks. They push them up like crazy. And so you just have to understand that since we're in this greedy environment, people have bought shares in stocks that might not even exist. I mean, we talk about the movie business like AMC, right? I found out this weekend that I have a free service because I already have cable called HBO Max, which is going to get every single new movie from Warner Brothers in 2021 at the same time as it goes to the movie theater. Now, I got kids and they love going to the movie theater and they love spending all of daddy's money on popcorn and fruit punch and Sour Patch Kids. And I'm like, dude, we can watch this movie for free instead of me spending $100 just to see Wonder Woman. We're sitting on the couch. So, but that doesn't stop investors from being greedy and still buying stocks and businesses that I don't even know are going to exist in the future. So I feel really good buying shares of a company like Newmont. We have the dollar debase story is going into full swing now. It's happening all over the world. It's not just the dollar. It's just a fiat currency massacre everywhere. And so I think this is a nice area to nibble on gold a little bit personally.
Sure.
And I just wanted to clarify something, James. I don't, my analysis was kind of doomy and gloomy, but remember last February, March, and April, after that shakeout happened, we still had some strong sectors. So if we do go through what we went through beginning of this year, I still believe that there's going to be some sectors that are going to be the stay-at-home sectors, obviously. That's what I'm talking about. The Peloton, the Zoom, all those other stocks. I think we will still see strength there. So I'm not saying that the market's going to come undone. The world's going to fall apart. But what I'm saying is we may have to be a little extra selective. Just wanted to clarify that.
There's a lot of greed out there, man. They're priced there. Airbnb just raised their IPO pricing by 20%, not even batting an eyelash. That's a travel stock. That's a travel stock that just raised.
Let's talk a bit about
the travel stock. What?
Let's talk a bit about the your trading gold seems particularly astute, Jeff, because some of my associates at some of the world's largest capital pools have pulled out of the S&P 500 and Dow stocks completely, anticipating what they see as an inevitable correction of a large scale to the downside. And so the smart money seems to be running for the hills in the large capital positions, while it seems to me it's the retail trade that is still all exuberant, and buying gold seems like the greatest possible preparation for a major correction. So is that what's driving your trading gold?
Well, yeah, that, and I saw that things started to percolate, and because we still have this retail thing, the retail people can make the gold trade a home run too. There's just this greed, there's just this mentality that it becomes a self-fulfilling prophecy. And we're here in December, we're going into year end. Gold has been pretty much a pretty good performer still this year, and those stocks have done well. And so I think people are going to pile into them at year end, and I'm nervous. I think there's going to be a blow off top in some of the exuberant tech stocks. And I don't know when or how that happens, but like Jeff Y was saying earlier, you have to be careful in your sizing. So I'm really careful in my sizing right now, because it's you don't want to fight it. But at the same point in time, when you have this kind of stretch in a market, you can expect a pretty significant correction. I think it's going to probably happen in January, possibly on Biden's inauguration day. But, who knows? We don't know. But I do know that a lot of the reasons that a lot of these stocks and the dollar being weak has been a big propeller of returns over the past couple of weeks should continue to be in place for gold to move higher.
Right. Okay, Jeff Yasteen, what are you seeing for gold?
Yeah, actually, I was going to say it's a great point that Jeff C's making. I bought two gold stocks last week. The first in a while for me, it was Humana and Hecla. And, going to the point about buying small, that's the great thing about so many of these gold stocks. They've pulled back very nicely. And I like the juniors here. And, they've carved out, what I obviously am presuming are bottoms. And the nice thing is, because they don't have a lot of volatility right now, you can buy more, and you know where you're going to put your stop at. And basically, if they explode to the upside or just gradually move to the upside, it's great. You're not having to buy into the higher volatility stocks, which again require you to buy smaller amounts of shares in order to keep your risks the same for your portfolio. So I like gold here, and I can't remember if I've said this in the past few weeks, but the pullback, to the 200-day moving average, it seems like just it's a good bet to be making here. That it's just a nice standard garden variety pullback. Everybody else has moved on to crypto and all the rest, and you can sit here and buy a lot of these things while but everybody's looking the other way essentially.
Sure, Adam, do you have a position in gold?
I do. I'm long the gold futures and a few gold stocks as well. So I do fully agree with both Jeffs here and Roger as well. Gold's a great place to be for many reasons. One, it's a hedge against inflation. We're printing unprecedented amounts of money, and this is a big global experiment. Every major central bank is just pedal to the metal, print, baby, print, and we don't know what the outcome is going to be. If you look at history, or you want to get any kind of semblance of reason or logic, or go sit in an MBA class, they'll tell you when you print like crazy, you're going to get inflation, and in many cases, runaway inflation. So the gold trade, going long gold, especially at these levels or down here, is a great trade and a perfect example of buy the bounce after that dip. We had that big dip for the last few months. Now it's bouncing off of support. Perfect area to get into, and it makes perfect sense. And you have a great risk reward trade, because if it doesn't work and it rolls over, you can get out right below the recent lows or below the 200-day moving average, and it's a really good risk adjusted trade. If you don't have inflation kick in, because inflation's been subdued for many reasons, but it's been subdued, gold still can go up, and that's the other side of it too. And if you look at other metals like platinum, it's on fire. Palladium doing very well. Copper, new highs, and so on and so forth. So the entire metals complex is acting extremely well. So for the fact that gold is pulling back in here, it's a great way to diversify your portfolio. Also, it's not correlated to the S&P 500 or to the stay-at-home stocks like Roger mentioned earlier. So it's a great non-correlated trade as well.
Sure. So Roger, I'm hearing by the group here that 2021 is shaping up to be a metallic commodities market. Gold touched a high at, what was it, 2085 earlier this year, poised to go higher. Goldman Sachs falling 2,300. Copper touched the highest level in 9 years. And so is this where we should be going into 2021, with imminent more central bank printing and modern monetary theory ruling the sentiment of central bankers?
Well, that's a very good question, and let me bring another. Yes, I do believe that's the fact, but let me give you guys another evidence that gold is a good asset to get into right now. And I'm sure some of you guys here already know about it, but as soon as the S&P has been leading till, I would say, for about a year and a half now, and then as soon as we started getting the runners from Biden and so forth, that as soon as we started seeing some runaway movement from Biden, we started seeing the Russell lead. Well, let me tell you what's happened in the last couple of weeks. Emerging markets have been leading, even ahead of the Russell. And that's very, very good for the gold and for the metal complex, because what that's showing us is, it's showing us that money is starting to move outside of this country. If you recall, with Trump running the show, typically when you have a Republican administration, you have money concentrated in the U.S. When you have a Democratic government, money is more globally moving out of the U.S. And we are seeing that right now. If you look at EEM, ticker symbol EEM, or if you look at VWO, those are both emerging markets. On a relative strength basis, they have been outperforming the S&P. And that's another major indication that metals are going to have a run up, because typically when money's coming into the US, it's going to impact the US stock market the most. When money's coming out of the US, it's going to move into emerging markets and global metal markets. So I agree with everybody here, but I just wanted to also give you another point, another clue that we're all pointing in the right direction. And if you look at the typical performance of gold and emerging markets, there is some correlation there. So I agree with everybody here. I would not give up gold. I think, and another thing about gold is when you see a run up in gold, gold tends to be a trending market. You don't see a lot of hot and cold movement in gold. If gold is going to move, it's going to move, or it's just going to kind of fizzle out. It's not going to do anything. Gold's only had 5 trends in the last 50 years, but each of those trends have been monumental. So yes, I agree with everybody here. I think miners is not a bad bet. Some miners are actually outperforming gold right now. And then some gold stocks are even outperforming the materials, the metal itself. That's very positive. The fact that money is moving back into global economy is very positive for gold. And the fact that emerging markets are leading even ahead of the Russell right now is even more positive for gold. So yes, I agree with everybody. I think gold is going to make a headway. I think commodities in general are going to start making some movement in 2021, partly because of what Adam has been saying, because of the inflationary pressure we may be seeing, but also because typically with this type of economic climate and political climate, we tend to see more upside in global assets, and gold is definitely a global asset.
Sure. Okay. Jeff Yasteen, on that note, commodities, metallic commodities in particular, being perhaps the trade of 2021, at least in the first quarter, iron ore is even touching all-time highs now as China sort of recovers its appetite for the metallic inputs to its industrial complex. Is it going to be a broad spectrum race to a new high across the metallic commodities index, in your opinion?
Well, if I had to focus one place, besides gold, as we talked about, and perhaps silver as well, is what Adam mentioned a second ago, which is copper. To me, it's like, obviously the world can't function without it. It has that sort of leading indicator quality to it. And the other aspect is the background fundamentals for it. I mean, if we're going to go to some sort of electric vehicle future in the developed world and increasingly in the emerging world in coming decades, I saw something the other day that said that there's like 7 times as much copper in an electric vehicle as there is in a ordinary gas or diesel burning vehicle. And so that alone tells you, gee, maybe we should be buying copper. And I think Goldman Sachs came out with a note last week or the week before that, talking about basically I'm paraphrasing here, but basically a super bull market in copper. So if you had to focus one place in industrial metals, to me that would be the place to go.
Okay. And Adam, do you have diversification across the metallic commodities?
Yeah, I think your iron ore point is fantastic. I'm a partner in a shop and we trade futures in China, and they have crazy markets over there that you can't even think of. I can't even pronounce some of them, but some of them are. Iron ore tends to be one of the strongest ones. We've done extremely well there. Hot rolled coils have done extremely well also, and so on and so forth. I can go into a lot more, but there's no point. But the view here is that, yes, there's a tremendous amount of money. To Roger's point, you have these mega trends that's what I call them, at least. It's not an official term, but these mega trends that tend to show up in the commodity complex. And when you get these mega trends, they tend to last for a long time. Now, granted, you do get pullbacks and corrections within those trends that are very, very deep and very ugly, for lack of a better word. But those pullbacks are normal and healthy because they shake out the weak hands. They shake out everybody that's late to the party. And it offers savvy investors a chance to reset the playing field and then get back into those mega trends when it pulls back, and then it offers a new buy point. So yes, as we go into 2021, I think the metals are very well positioned here. Some of them are extended due to pullback, but they're in the early innings, at least I believe, of a new mega trend that could last for many, many years. Another area that I think that I like a lot here, another two areas within the stock market would be the financials and the healthcare stocks. Obviously COVID, not just COVID, but we have lots of other diseases as well that people have to deal with. I'm on the board of a breast cancer charity, and people just forgot about it, but they're there. These issues are there, and the demographics are aging in the US. We're living longer, and as we live longer, we need more healthcare, and those stocks, the healthcare stocks, tend to do well. So it's a big secular mega trend as well that'll last for a long time. And I think the healthcare stocks are definitely a place to be. And then financials, after we get through this COVID, situation, we're going to have a recovery. The economy is going to do better. And as the economy does better, you're going to have more money moving in the system. And as more money flows into the system, the financials tend to benefit because the banks love having money flow through their doors. And those are the reasons why I'm bullish on those areas as well.
Sure. Jeff Sandinier, in the context of commodities super cycles, is it safe to say that the expansion of the monetary base by central bank printing is a signal that it's a good time to diversify across metallic commodities, not just gold? And are you playing that strategy at all?
I am a little bit weary about the timing of that. I think the super cycle is a good case, but from just like a pure now being the time, I'm a little bit skeptical about the broader metal rally because of the economic underpinnings that are required to validate those moves. Unlike gold, copper is a conduit and an asset class that people invest in when they expect huge economic expansion globally. I do not expect that. So I'm a little bit weary. I think this is more of a debasement story. This is more of a weak dollar story. This is a rebound from the pits of hell story. But to justify an extra 50% in copper from here, for me, is a difficult case to make. An easier case to make is in gold, obviously, but it's a difficult case for me to make in copper. As Roger was saying, you get all these months and months of hell that still await us, and there's been a psychological impact that you can't discount, and just the way business is conducted has been, in my opinion, changed, and the axis of the earth has in fact been changed by this. So for me to be a full bull in the super cycle of these metals would mean that I would subscribe to this economic growth story globally that I just don't.
Right. Okay. Well, that's great, gentlemen. Food for thought this week. We're going to leave it there for now. Thank you very much for joining me, and I look forward to talking to you each individually throughout the week. Have a fantastic trading week.